I'll be describing for you the reasons for and effects of the weakening Chinese economy. Let's dive right into why the Chinese economy is getting worse. Real estate decline. The real estate industry makes up 29% of China's GDP. One of the biggest real estate developers in the world, Evergrande, experienced a circumstance last year that can only be characterized as the beginning of the Chinese real estate market. Let me briefly review it for you. Investors were alarmed when Chinese real estate behemoth Evergrande, whose liabilities exceed $300 billion, failed to make interest payments to foreign investors. As the enormous companies scrambled to find a solution, investors feared a ripple effect across the Chinese real estate and banking sectors. In order to pay off its debts to its own employees, investors, suppliers, and clients, Evergrande also started selling assets. This, however, did not endure for very long. Finally, Evergrande missed a debt repayment deadline and went into default on 2 bonds. Many people had purchased unfinished properties from Evergrande, and a default meant people may lose all of their money. This was only one of the many reasons why Evergrande's troubles were a huge concern for the economy of China and even on a larger scale. Additionally, defaulting on overseas loans resulted in the bankruptcy of numerous businesses. The real estate industry's harm hasn't healed as of 2022, it's becoming worse. Property values are plummeting as a result of the 1% per month decline in the Chinese real estate market. Additionally, other real estate behemoths are experiencing defaults as a result of a variety of problems, not the least of which is China's problem with ghost cities. You can see that approximately 20% of China's total urban housing units, or roughly 65 million units, are unoccupied. Large portions of cities like Tianducheng, Thames Town, Binhai, and many others are included in this 20% may cover hundreds of square kilometers, but have much more vacant structures than ones that are occupied. Despite having well-connected roads, infrastructure, buildings, and a variety of public spaces, such ghost cities in China contain extensive sections that are entirely devoid of inhabitants. The typical description of a ghost city is one that formerly had a large population and a strong economy but is now in decline. The opposite is true for the Chinese. Although its 3rd and 4th tier cities are completely developed and hold the potential to become economic centers, they are unable to draw people because of high investment prices or a lack of employment prospects. Involves funds linked to vacant, unsold, and unlivable buildings. Real estate firms are in precarious situations. The difficulty that follows for developers could have a substantial impact on China's financial system. Banks and other lenders may be forced to lend less if multiple real estate, developers, and businesses fail, as Evergrande did. This might result in a credit crunch, in which businesses find it difficult to obtain loans at reasonable rates. Credit crunch. Accordingly, a credit crunch would be particularly negative for the 2nd largest economy in the world, since businesses that cannot borrow find it difficult to expand and occasionally are unable to continue their operations. It was essentially assured that businesses could not obtain new debt once the CCP implemented its 3 red line policy, a set of guidelines that simply caps the amount of money a company can borrow. This led to bond price sell-offs and stock price declines for the corporations, who were now cash-strapped. It makes sense that such a reaction would take place given that about 90% of the Chinese population has connections to real estate and home ownership. Who would want to purchase bonds from a floundering company, after all? Bonds are designed to ensure security. As a result, the largest bond in China had withdrawals of $460.4 million just last month as money continued to flow out of Chinese assets. In addition to real estate values dropping, real estate development firms are unable to obtain further funding to complete and begin projects. The issues only worsen as investors withdraw huge sums of money from Chinese markets. When a factor that contributes to roughly 1/3 of the country's GDP experiences such serious problems, you can be sure that the Chinese economy will be hit hard. Right. China's problems still have unresolved root causes. Hold on, though. You'll be eager to learn about the following one. Intense regulatory pressure from the CCP. The CCP is involved in every aspect of life. Everything, by which I mean everything, is proven by the Alibaba sanctioning, which resulted in enormous losses from which the firm has still not fully recovered years later. The Ant IPO, which was slated to be the biggest in the world, was stopped by the CCP in order to severely harm Jack Ma. This followed Jack Ma's making remarks that the government found offensive. What the CCP did with Jack Ma, and has since done with hundreds of other enterprises, simply serves to highlight how incredibly challenging it is to be successful in China. Once a business grows too big and its owners become too powerful. In order to prevent them from having too much power, the CCP steps in right away. However, this prevents businesses from reaching their full potential. It also limits the amount of growth one can have outside of politics, also known as aiding the CCP. The CCP has recently been engaging in market manipulation at its best thanks to its influence. This indicates that there can be no trust in the Chinese stock market's natural behavior. The stock market routinely experiences double-digit fluctuations in both directions. And anyone with the slightest grasp of how safe investing should proceed does not find this encouraging. When they thought they were on the losing side in terms of public opinion, the CCP has even gone so far as to pour billions of dollars into the Chinese stock exchange to inflate it. Due to this trickery, unaware investors have lost millions of dollars. Something the CCP is aware of. Has declared that they will relax severe controls on both the stock market and the real estate industry, but this position is well worn. Even if we have heard these remarks before, the outcome has remained the same. With the CCP in charge, China is no longer imaginable. Only 9% of Chinese citizens invest in the stock market, thus the lack of foreign capital is going to have an irreparable negative impact on Chinese equities and enterprises. If you own Chinese stocks or are thinking about purchasing any, now is the moment to severely reconsider, or at the very least, make sure you have the stomach for it if the factors contributing to the Chinese economy's decline persist. The following ones, which I shall explain, are ones that you cannot afford to miss. Foreign and domestic policy challenges and effects. A significant factor contributing to China's economy's inevitable decline is the country's behavior on the international scene. You know, China's recent foreign policy has been appalling and has resulted in shaky or poor connections with the rest of the world. You obviously want to know how it might affect the economy, so let me explain. China is a country that exports consumer electronics, data processing, technologies, apparel, other textiles, optical equipment, medical equipment, and the list continues on and on are all exported from China. The issue is that the nation's most valuable clients despise it because of the foreign policy they pursue. As a result, the partnerships and commercial agreements become exceedingly vulnerable. In order for China to continue developing, economists estimate that it will need to transition to a service-based economy within the next 10 years. Or at the very least keep it moving forward. Some people in the country and its economy worry that the USA will punish China for its links to the Russian leadership in light of the Russian invasion of Ukraine. This is in light of China's possible backing, tolerating, or deliberately paving the diplomatic way for Russia to carry out what appear to be generally unpopular acts. Whether this occurs or not is still up in the air. However, investors are uneasy about the potential. One may argue that China's internal problems also pose a threat to the country's internal collapse. One of the biggest is their uneven population, which has more older individuals than people from lower socioeconomic classes. The impacts will intensify over time as the negative repercussions of a low birth rate continue to affect the nation. The tax revenue generated by the working population will soon be insufficient to maintain a sizable retiree population. Shanghai COVID-19 lockdown. Shanghai, the country's second-largest city, was only recently declared to be entering another state of lockdown. Despite the protests of numerous citizens. This was once a level 2 lockdown, but now everyone must stay inside their homes. This obviously has a detrimental impact on economic growth. You know, if this continues in Shanghai alone by the time the lockdown there is released, it is predicted to have a negative effect on the GDP of the entire country by 0.4%. This might seem insignificant, but when you consider how big the Chinese economy is, you realize how much money is at stake. Since 2020, Chinese cities have experienced a shutdown after lockdown. Furthermore, the most recent Shanghai lockdown strengthens the argument being made by the firms that were impacted. You see, both the nearby Tesla Gigafactory and the nearby Apple factory will be impacted by the lockdown in Shanghai. If this keeps up, the aforementioned businesses may decide to move abroad, which would be quite costly for China in terms of lost taxes and job prospects from just those two businesses. Last but not least, the lockdown of such a large city will make supply chain problems that were previously a concern and were still being resolved worse. A metropolis with a population of about 30 million. The fact of the matter is that China is having serious problems. More issues than many would like to acknowledge at this time. With all the problems listed above, it is clear that the economy will only need a small number of additional catalysts to collapse. It will be interesting to see when and how the Dragon of the West will respond to this, I suppose. From our discussion, what have you learned? Please let me know by leaving a comment below. And if you enjoyed this video, please press the like button, turn on the notification bell, and subscribe to Wealth-ology for more videos like this. Thank you for stopping by to watch. See you in our next video. Bye.